Good afternoon, everyone. My name is Michael Naidrich, and I am the co-CEO of AmeriVet Securities. And as always, I am joined by my partner, CFA, all things Fed, liquidity, Gregory Faranello. And we have our second-time guest today from Société Generale, Subadra. So thank you so much for joining us. I think this is actually a very interesting meeting because I actually think the forward-moving part after this meeting is going to be extremely important. So I'm really interested to see what the two experts have to say. Again, Subadra, thank you so much for joining us for a second time. And Greg, I hand it over to you, bud.
All right, thank you, Michael. Subadra, it's great to be with you again. And thank you for joining us. We're very fortunate to have you like we did last time, and things look a little bit different this time. I'd love to just dive right into it for our clients, our viewers, and get your thoughts on the upcoming meeting on Wednesday. And if you could just sort of frame that out for us, right? There'll be a number of different parts, obviously the statement, the decision, the presser. I'd love to get your thoughts heading into Wednesday.
Thank you, Greg, for having me, and Michael as well. I'd say that what we're expecting for Wednesday is a 75 basis point rate hike. The market's fully priced in for that, and what we'd be really looking to hear is what the Fed Chair Powell has to say at the press conference, as well as any changes in the statement itself that might lead us to some idea of what they might do going forward. I mean, at the last meeting, they were very forthcoming on forward guidance. They told us that at the July meeting, they'll be raising rates by 50 or 75 basis points. I'm not sure that they are, we're going to get that sort of forward guidance for the September meeting, especially given the fact that the data is starting to weaken. And they probably take a lesson from the ECB and try to be a little bit more careful on forward guidance. So the changes to the statement, as well as what they say at the press conference, is going to be very, very key in guiding the markets towards what they're thinking about policy for September, as well as beyond. I mean, for the most part, I think that the Fed is ready to deliver and front load rate hikes at the September meeting. But again, it really depends on what their outlook is on data going forward.
Sure, and if we can, I mean, let's talk about that data. I think, to me, one of the more interesting things with this meeting is the next meeting is still 2 months away. And as you and I know, 2 months in this time frame is an eternity. So, and the market has been, to your point, it's been grappling with growth, fears of recession, and yet high inflation at the same time. I'd love to get your thoughts on that in-between period. Obviously, we'll have Jackson Hole as well. How do you see that playing out into the September meeting?
Yeah, no, I think like you rightly pointed out, we get a lot of data between now and the September meeting. Inflation continues to rise. We don't know if it's actually already peaked. If you look at some of the other sort of leading indicators, things like initial jobless claims have been rising over the last several weeks. You look at ISM, the manufacturing data seems to be softening. The services sector is also showing signs of weakening. Housing data that we got last week, again, you're starting to see some slowing down in housing activity, which is probably what the Fed wants to see happening. But data in general seems to be much more on the softer side in the last couple of weeks. And in the next month or a month and a half, we'll get a lot more data that'll guide our views on what's going to happen with rate hikes. Like I mentioned just a little while back, I mean, I think that the Fed is very keen on front-loading rate hikes, so they might try to squeeze in another 50 basis point rate hikes. But beyond that, after the third quarter into the fourth quarter, when they have a lot more data, I think they take a much more measured approach on rate hikes, and perhaps use a much more data-dependent approach to policy going forward.
Yeah, that's very interesting, and it leads me into, I guess, the next question, and I think this is where, as you and I know, a lot of volatility has come into the marketplace. So if we see that scenario where data continues to weaken and the Fed does become much more measured, I guess the question is, where do you see the terminal rate shaking out? We've had this rally of late on the back of the PMIs coming down, 10-year yields getting in and around 275, which appears to be the lower end of the range, which has sort of coincided with somewhere around a 3.25 terminal rate. And then at the peak, we priced in close to a 4% terminal rate. Now, how do you see that playing out as we head into the latter part of 2022 and then into 2023?
So you're right to point out that the market pricing of terminal Fed funds rate has moved almost 100 basis points lower. I mean, the one metric that I look at is the 1-year forward, 1-year YS. That was close to 3.8% at the June meeting, and now we're almost 100 basis points lower in that rate. So we're around 2.8% right now. So the market has significantly repriced its expectations lower for where the terminal Fed funds rate should be. The market now expects the terminal Fed funds rate to be, or rates, Fed funds rates in general, in this cycle to peak in the January-February timeframe. And we're pricing in for nearly 50 to 75 basis points of cuts for 2023. So this is a complete reversal from where we were back in June, when the market was pricing in a very aggressive path of rate hikes. So for me, it just doesn't make any sense that the Fed, yes, inflation, I think, is going to remain hotter and for longer than people expect. But I don't think that see the Fed indiscriminately continuing to raise rates as the economy slows down and the data starts to slow down, especially on the growth front. I think a better approach would be for them to try to front load rate hikes, maybe get the Fed funds rate to around 3.25% by the end of the third quarter, and then take a much more measured approach. Because there's no, to me, it doesn't make any sense for them to continue to raise beyond 4% and then have to cut rates much more aggressively when the economy starts to slow down.
Yeah, the forward curve is pretty amazing, right? When you look at it beyond 2022 into 23 and 24, in terms of how efficient the market thinks it is in terms of the Fed, taking rates up and then taking them back down again, which I think is pretty amazing at this point. I want to, if you can, I'd love to briefly talk a little bit about other markets than the U.S., the ECB in particular, Europe in particular. Obviously, the story of last year really into this year has become an unbelievable global story. And it's hard to, as you and I know, look at the US market in isolation without looking at Europe. So briefly, what are your thoughts on the ECB, their recent decision, the program that they put in place to protect some of the peripheral spreads, and sort of maybe your viewpoint going forward for the rest of 2022?
I mean, if we think policy is tricky in the US, it's a lot more trickier for the ECB. Consensus expectations from economists there is for recession. I mean, the probability of recession right now is anywhere between 40 to 50% for the next 12 months. They have an energy crisis, an ongoing energy crisis that's only getting worse, and they're very concerned about the rise in headline inflation. So, that's their justification to try to front load rate hikes. But on the same note, growth is starting to deteriorate quite meaningfully. So I think that it makes policy very, very tricky for the ECB. At the last meeting, I mean, clearly they kind of strayed away from their forward guidance for a 25 basis point rate hike, and they delivered a 50 basis point rate hike. They also introduced this new mechanism called the TPI, the Transmission Protection Instrument, and really, in some respects, I was struggling to get more information on what this program actually means. We still don't know what the triggers are for when they'll start using the program, what the size of the program would be, and given sort of the turmoil in Italy and the volatility in periphery spreads. It's a little bit more clarity on the TPI would be definitely much more welcome by the market. So, in short, I think that they have a very, very tough job in their hands between, tightening monetary policy for inflation and also dealing with very, very heightened recession risks.
Yeah, it is certainly, I'll use the word unprecedented times, right? To say the least. Europe seems to be in a very tough spot. Perhaps the Fed has a little bit more flexibility here to continue to tighten along those lines. But well, this has been great, Subadra. I appreciate all of your insights always, especially with regard to the ECB. And Michael, I'm going to turn it back to you if it's okay.
Absolutely. So first of all, again, Subadra, thank you so much for your time, being so generous with us. And I have a feeling you're going to be our first time, third time guest soon enough. So we appreciate that very much. Greg, I guess I'll ask you just, we've seen like a decent little rally here in the markets the last, let's call it 3 weeks. The NASDAQ, I think alone was up 3.4% in the last week. Are you looking at this as sort of a bear trap, sort of short squeeze rally? Do you think there's some legs to this, or where do you see this moving forward?
Yeah, no, that's a great question. We've had a tremendous amount of destruction in my view, and we've been defensive risk assets for the better part of 2022. We can throw crypto markets in there as well. Those are extreme moves, and there are very big dislocations there that still need to be worked out. But having said that, I do think, and I'm not saying we've necessarily bottomed, but if Subadra's scenario plays out, and if you look at this year, right, we started with a few 25 rate hikes, then we went 25 to 50, 50 to 75. People talk about peak markets, peak inflation, peak growth, peak this. What about peak Fed, the magnitude of peak Fed hikes? So if this does become the last 75 basis point hike, and the trajectory of those hikes, the Fed continues to hike, but they do start to slow down into September and as Subadra pointed out, into the fourth quarter. Now, if the economy just dips briefly and still maintains some sense of strength, you can make an argument that risk assets can be looking at a different scenario, I think, in the second half of 2022. But like I said, it's very difficult to call bottoms in markets. But I do think largely what we've seen this year is markets, risk assets that have repriced around higher volatility and an extreme repricing in global interest rates and obviously central bank policy. So I'm pretty open-minded here in terms of how the second half looks, but I think a lot of that is going to depend on the trajectory of inflation and growth. And if inflation does come down with growth and the Fed does start to slow down, I think you will see risk assets respond to that.
Yeah, and for those of you who follow Greg and speak to him on a regular basis, that is definitely a much more, I'll say, open-minded view, to use your words, than where we've been, through the first half of the year, where you were extremely defensive and correct on assets and, market cap valuations. I think it'll be interesting. I think over a third of the S&P reports this week. There's some big names out there in Google and Apple, Alphabet, I guess, and others. And, I just think that it's always important for us and our viewers to get an understanding. And what I always say in this is the meetings will be what the meetings will be. But, diving into Chairman Powell's presser and kind of getting the vibe of where he's headed or where they're headed as a group is always the one that becomes most interesting to me. And that's one of my favorite parts about working with you, is the way you dive into the presser and look for every, sort of edge in figuring out what they're saying. So again, Subadra, I can't thank you enough. This has been amazing. Greg, you're my partner. This is what we do. We've been doing this for a long time. I look forward to the next one. And as always, to our clients, continued safety. It's still a real thing out there. And if any of our clients would like to speak to Greg, like many of you do, please call your representative at AmeriVet, and we'll be happy to put that together. I wish everyone a great week ahead. Thank you.